A strange pattern appears when someone gains $100,000. Spending rises faster than thinking. The number looks like freedom, but behavior quietly turns it into a new cage. What should create options often creates pressure instead. The first observation is simple. A sudden jump in money changes decisions immediately. Purchases feel smaller, risks feel safer, time feels more abundant. But the math does not agree. $100,000 is not infinite. It is a resource with limits. Or yet the brain treats it like a reset button. This happens because of mental accounting. The mind separates money into emotional buckets instead of treating it as one system. Earned income feels hard. A sudden gain feels extra. That difference changes how it is used. The brain rewards itself for reaching the milestone, even if the reward quietly destroys the advantage. What most people miss is this. The first $100,000 is not about lifestyle. It is about positioning. At this level, money has not reached escape velocity. It cannot sustain a life. It can only accelerate one. A better model treats $100,000 like a seed, not a salary. Seeds are not consumed. They are planted, protected, and multiplied. The goal is not comfort. The goal is compounding. The practical shift is restraint with intention. Instead of asking, "What can this buy?" the better question becomes, "What can this build?" Every dollar gets assigned to growth, not relief. Another pattern appears. After gaining $100,000, attention shifts outward. Bigger houses, better cars, more visible success. The environment begins to influence decisions more than logic. This happens because humans compare by default. Relative wealth matters more than absolute wealth. The brain measures status, not sustainability. A person with $100,000 in a room of millionaires feels poor. In a different room, the same person feels rich. What most people miss is that comparison resets the baseline. Satisfaction moves further away the moment it is reached. This creates a loop where more money leads to less contentment. A better model replaces comparison with independence. Wealth is not how much is seen. It is how long one can operate without needing approval or income. The practical shift is silent progress. Fewer signals, fewer upgrades, more focus on invisible metrics like savings rate, investment growth, and time freedom. Another observation follows. Many people diversify too early. They spread $100,000 across too many ideas, a little in stocks, a little in crypto, a little in business, a little everywhere. This happens because diversification feels safe. It reduces fear, but at small scale, it also reduces impact. When capital is thin, spreading it creates average results. What most people miss is that diversification protects wealth. It does not build it. Concentration builds wealth. Focus creates asymmetry. A better model uses strategic concentration. One or two high-conviction paths receive most of the capital. The rest remains liquid for opportunity or protection. The practical shift is clarity over comfort. Instead of trying to win everywhere, the focus becomes winning somewhere meaningful. Another pattern emerges with time. People believe $100,000 buys freedom from work. The assumption is simple: more money equals less effort. This happens because income and wealth are confused. Income is flow. Wealth is storage. One supports life. The other extends it. What most people miss is that $100,000 does not replace income. Even at a strong 10% annual return, it produces $10,000 per year. That is not freedom. That is support. A better model separates income engines from capital stores. Money should either generate cash flow or grow in value. Ideally, it does both. The practical shift is building systems. Assets that produce income become the priority. Skills, businesses, or investments that create recurring returns replace one-time gains. Another observation appears in risk behavior. After gaining $100,000, some become too cautious. Others become reckless. Both reactions lead to stagnation. This happens because of loss aversion and overconfidence. One group fears losing what was gained. The other believes it can be repeated easily. What most people miss is that risk is not binary. It is adjustable. Smart risk is calculated, not avoided or chased. A better model uses asymmetric risk, small downside, large upside. Decisions are made where potential gains outweigh potential losses significantly. The practical shift is structured experimentation. A portion of capital is allocated to high-risk, high-reward opportunities. The rest remains protected and growing. Another pattern reveals itself in spending psychology. Lifestyle inflation begins quietly. Small upgrades become habits. Habits become identity. This happens because comfort adapts quickly. What once felt like luxury becomes normal. The brain stops noticing gains and starts noticing gaps. What most people miss is that expenses compound negatively. A higher lifestyle requires higher maintenance. This reduces flexibility and increases dependence on income. A better model treats lifestyle as fixed and investments as variable. Instead of upgrading life with income, life remains stable while assets grow. The practical shift is delayed gratification with purpose. Upgrades are tied to passive income, not active earnings. Another observation concerns knowledge. Many believe gaining $100,000 means understanding money. Confidence rises faster than competence. This happens because results are mistaken for skill. A single win feels like proof, but markets, luck, and timing play a role. What most people miss is that wealth requires systems, not moments. One-time gains do not guarantee repeatable outcomes. A better model prioritizes financial literacy. Understanding cash flow, assets, liabilities, and compounding becomes essential. The practical shift is continuous learning. Time is invested in understanding how money behaves, not just how it is earned. Another pattern shows up in opportunity cost. Every dollar spent removes a future possibility. But this is rarely considered in the moment. This happens because the future feels distant. Immediate rewards feel real. The brain discounts long-term impact. What most people miss is the exponential nature of compounding. $100,000 growing at 10% becomes over $259,000 in 10 years. Over $672,000 in 20 years. Time multiplies discipline. A better model visualizes money as time machines. Each dollar can travel forward and return with more. The practical shift is thinking in decades, not days. Decisions are evaluated based on long-term outcomes, not short-term satisfaction. Another observation involves control. People try to control markets, trends, and outcomes. Energy is spent predicting instead of positioning. This happens because uncertainty feels uncomfortable. Prediction creates an illusion of control. What most people miss is that control lies in behavior, not markets. Savings rate, investment consistency, and risk management are controllable. A better model focuses on inputs, not outcomes. Consistent actions replace perfect timing. The practical shift is automation. Investments happen regularly, regardless of emotion or market noise. Another pattern appears in identity. After gaining $100,000, some begin to see themselves as wealthy. Behavior changes to match that identity. This happens because identity drives action. People act in alignment with how they see themselves. What most people miss is that premature identity can lead to premature decisions. Acting rich before becoming wealthy creates fragility. A better model builds identity around discipline, not status. The focus shifts from being wealthy to becoming financially independent. The practical shift is humility and progress. Success is treated as a stage, not a destination. Another observation concerns liquidity. Some lock their entire $100,000 into illiquid assets. Access disappears. This happens because long-term thinking is applied without flexibility. Commitment replaces adaptability. What most people miss is that liquidity provides optionality. Opportunities require accessible capital. A better model balances growth and access. Some capital grows long-term, some remains available. The practical shift is maintaining a reserve, not for emergencies alone, but for opportunities. Another pattern emerges with information. Noise increases as money grows. Opinions multiply. Advice becomes overwhelming. This happens because attention follows money. And more capital attracts more voices. What most people miss is that most information is irrelevant. Only a small percentage affects outcomes. A better model filters aggressively. Focus remains on principles, not trends. The practical shift is simplicity, fewer decisions, clear rules, consistent execution. Another observation is emotional volatility. Gains create excitement. Losses create fear. Decisions follow emotions. This happens because money is tied to survival and status. All emotional responses are natural. What most people miss is that emotions reduce performance. Reactive decisions destroy long-term plans. A better model uses systems to override emotion. Predefined rules guide behavior. The practical shift is discipline over feeling. Actions remain consistent regardless of mood. In the end, $100,000 is not a finish line. It is a test. It reveals habits, beliefs, and blind spots. It amplifies behavior more than it changes outcomes. Those who treat it as freedom often lose it. Those who treat it as fuel often multiply it. The difference is not intelligence. It is perspective. Money does not reward effort alone. It rewards structure, patience, and clarity. If this breakdown shifted how money is seen, then the next step is simple. Apply one principle, build one system, make one better decision. And if more clear, calm, and powerful financial thinking is useful, subscribe for more.